Thank you so much for tuning into today's Talking Point. I'm your host, Neeraj Shah. And the case for a chat, well, there are multiple things to talk about. One, the post-Fed view, if you will, and does that change anything materially? So that is the key aspect of talking to Harsha Upadhyaya, our guest today. Of course, there are lots more to talk about, and we'll get to all of that. But Harsha, take a moment for thanking you to joining in and wondering if higher yields and higher for longer rates, or maybe a rate hike, were the principal concerns for risk assets, does yesterday's Fed narrative and action change the dynamic a wee bit, or we still need to wait for cuts to come in before we think of a change in the narrative?
Hi, Neeraj. Clearly, I think yesterday's Fed move and the commentary along with that gives a breather for the markets. I think it has calmed a lot of nerves. At the same time, I would say that we are unlikely to see very low rates in the near term. So, to that extent, higher for long continues to hold. Yes, there was a fear that given how crude oil prices have moved up and how yields have moved, whether Fed will continue to raise further rates. I think this is a second successive meeting where they are not increased rates. So to that extent, maybe we are nearing an end in terms of the short-term interest rate cycle. However, the fall in interest rates will be slower to come by and will also depend on how commodities move, how economic growth numbers pan out, etc. So it will be more data dependent. So to that extent, I don't think there is an immediate cheer for the markets of a lower interest rate trajectory as yet.
Got it. We've corrected a little bit from the highs of the last 3 months, circa 5%, give or take a whiff here and there. Are these corrections meaningful enough for an investor like you, or for the domestic investing or institutional community to start deploying some of the gunpowder? We were just looking at a Morningstar study and a story that we did, which suggested that end September at least, mutual funds, domestic mutual funds had gunpowder to the tune of 90,000 odd crores dry, waiting to be deployed.
See, clearly, some of this consolidation helps in terms of reaching a valuation level which is probably more comfortable for investors, especially on the large cap side. However, the mid and small caps still continue to trade at a multiple which is much higher than large caps, and also compared to their own historical valuations, we are at a fairly higher level. So, to that extent, also we must remember that earnings expectations in the mid and small cap basket is also much higher, almost 10 to 12 percentage points higher than that of Nifty or the large caps. So to that extent, the room for disappointment is much higher in case of mid and small caps. We continue to remain positive on all three buckets from a medium to long term perspective. However, in the very short term, we are unlikely to see that kind of a volatility, even if some negative event were to pan out in case of large caps. However, same cannot be said about the mid and small cap basket. The volatility could be higher in case of a market correction, or in case earnings don't pan out the way the markets are expecting. So that's the risk that any investor would probably face if he's putting lump sum investments into mid and small caps at these valuations.
Where is it, Harsh? I mean, you guys do your own prognosis, your research teams are so strong. Where is it that you believe the probability of the earnings misses are likely very high?
See, as of now, nearly 55-60% of Nifty basket has announced results. And when you look at the broader market, then the proportion of companies which have announced results will be much lesser. However, at the headline number, the earnings expectations have been beaten by about 3.5 to 4% as of now, which is good beat, I would say. Even if you are going to see some misses towards the end of the second half, which is usually the case, you may still end up with having similar numbers as the expected numbers for the Nifty basket. However, what we need to remember here is on a year-on-year basis, we had a very favorable base of September 22 when we are looking at September 23 quarter. as you get into the next quarter, the favorable base may not remain the same. And secondly, the crude oil has also moved up about 35% from the bottom. And there will be some companies which will face margin issues either in the December quarter or in the March quarter. Another issue has been the deficient monsoon that we have seen, and that will also play its part in terms of moderating demand in certain segments of our economy. So, to that extent, December and March may not be as strong as what we have seen in September. One, because of an unfavorable base. Second, because of the issues that I mentioned. So, overall, I think one needs to be a little cautious at this point of time. While we are seeing no red flags in terms of earnings in this quarter, we could see some in the next 1 or 2 quarters.
Yeah, I mean, just the commentary from the global agrochem companies seem to suggest that that pocket has issue. I was looking at the con call details from Mangalore Chemicals, and it seems fertilizers as issue. Some of the specialty chemical companies have come out and said that things haven't moved as per expectations as well. So those are the clear ones. Are there other pockets? I mean, there might be individual companies which might do better, but as a pocket or as a theme, are there things which are clearly at risk? Sorry if I missed it, if you said it. I was just trying to get some definitive thoughts from you about themes wherein the risk of earnings misses are the highest.
In case of consumption basket, we need to be a little cautious at this point of time. There was a hope that second half of this financial could be better, given that it's a pre-election year and a lot of rural initiatives will go on, and that should help revive rural consumption trends, etc. However, given our deficient monsoon, even if there is a pre-election spend in the rural areas, we don't know how much of that will actually translate into higher consumption. So that's a bucket which will probably see a muted demand trend. Margins, yes, margins have improved for this basket in the last couple of quarters. However, as I said, because of the unfavorable base that you have for the next 1 or 2 quarters, the improvement may not seem that great. So that's clearly one bucket where one may not see any positive earnings surprises as we go ahead.
Got it. The last time that we spoke to you, Harsha, you were circumspect commodities, and that call has worked out beautifully. I heard you say in your opening answer as well that you believe that commodities might still not be the best place to be in. Is this despite the possibility of a China stimulus or accounting for that?
Clearly, I think given with all the stimulus that may come through, global growth is going to remain subdued compared to the trends that we have seen in the past. So to that extent, I don't think there is going to be a positive trigger for the commodity pricing as such. Although, I mean, we are definitely surprised the way crude has moved up without any real fundamental change in terms of demand. All that has been because of the geopolitical issue, and also before that, how OPEC kind of decided to curtail production, etc. Other than that, none of the commodities seem to be showing any great strength in terms of pricing. So to that extent, one need not be overweight on this basket. One could probably wait for a little bit better economic scenario to actually take position in this basket.
Harsha, I was looking at a chart from a research note from Kotak Institutional Equities, which spoke about how the sanctions of the long-term projects thus far seems to suggest that while there has been a recent recovery, fresh sanctions of long-term projects are significantly lower than 2011 levels. And there seems to be, relative to what was estimated, the actual number of corporate capex announcements are much lower. Now, we know that the capex had to be government front-loaded, and that is evident so. But there was hope that towards the end of 2023, we might see corporate capex pick up steam. Do you think this gets deferred by 6 months owing to elections, or is it difficult to put a handle on when does corporate capex actually pick up steam?
Neeraj, clearly, if you compare it to the earlier peak cycle, we are nowhere close to that peak cycle. Or even if you compare it to 2011-12 numbers, probably we are not there, because that was a period where corporate capex was really, really high. And even after GFC, many of the capacities were still getting implemented. So to that extent, I don't think we are in that kind of a very strong investment cycle as yet. But there is always a lag between the corporate capacity expansion announcements and the actual implementation. There is probably about 18-24 month kind of a lag that is there between announcements and actual implementations. If you look at just the trend of announcements, so starting from financial year 21 onwards, we have seen quite a bit of an increase. And similarly, the implementation is also going up. It may not be to the extent of what we had seen in the earlier cycle, which I completely agree. But our sense is over the next 12 to 18 months, we will see more of those announcements which have already happened getting into implementation stage. So to that extent, we are not really negative on the investment cycle per se. Yes, it may not be as secular or as strong as the previous investment cycle at this point of time, but we hope that over the next couple of years, it could be even stronger than the trend that we are witnessing.
So could the nature of winners be different? Part one, and if there is a correction owing to global factors, owing to election-led factors, what have you, would you be selectively a buyer into any of these capex related themes, Harsha? Presuming you have gunpowder dry.
We do have an overweight position on the overall industrials. Yes, there have been pockets which have been expensive, which we have discussed in our earlier interactions as well. So to that extent, the incremental money has not gone into this bucket in the recent few quarters. But if there is a significant correction, which has to be more than what the market is currently expecting, then probably some valuation comfort will start to open up, and probably we could review our position further. But even without any correction, I think we are continuing to hold our overweight position, which may have decreased in terms of the extent, given that we didn't put incremental money into this bucket because of not so great valuation comfort. However, if markets do correct and this bucket corrects more than the market, then obviously we would be keen to look at that, given that medium to long-term runway is still very strong for growth in this sector.
Just one more question on this, Harsha. And again, maybe we've spoken about this in the past, but I'm inclined to ask this to you again. Is it better to bet on for lack of a better word, the ancillaries or the enablers, which might supply to each of the capex beneficiaries or most of the capex beneficiaries? Or would you bet on themes where one is clearly seeing evidence of government spend at the very least? I mean, there is railways, defense, green energy, power, etc., so on and so forth. Are you largely betting, or as a majority position betting on those, or are you betting more on the enablers, which might be suppliers to multiple such industries?
It's a well-diversified industrials exposure as far as we are concerned. We are dependent on public capex as well as private capex for our positions to work. And it's across various subsegments of industrials. It's not one or two pockets that we are positive on. And also, as I said, we wanted to diversify our risk, given that the valuations have moved up in this bucket. So to that extent, we have continued to bet on different subsegments of industrials, so that even if there is some slowdown or some delay in some of the order flows in any of the segments, we should not really get perturbed. So that was the idea, and we continue to maintain similar stance even now.
Got it. The other quick aspect, Harsha, I mean, there's a bit of a bounce in the NASDAQ. The rate moves typically have an impact there, but that notwithstanding, there's a lot of talk of when does IT kind of see an assumed bottom, if you will. But Cognizant's guidance cut has just happened this morning. Q2 conversations with any of the IT companies, save for the ER&D bucket, didn't seem very, very confident of an immediate recovery. Yesterday, we were speaking to, I think, Mahesh Nandurkar of Jefferies, who was saying that maybe hiring numbers are the first sure-shot sign of any possible recovery as well. What is your stance on IT services and ER&D, if you will? And what will lead you to change the stance, if at
all? Clearly, IT services overall continues to have kind of a very slow business momentum, as you rightly mentioned. And even the management commentary that we have seen across categories of IT services has not given any different positive opinion on the same. So to that extent, maybe we are a couple of quarters away at least in terms of seeing a great recovery in terms of IT services discretionary spend, which will only help our IT services companies to kind of see better investor acceptance at this point of time. However, ER&D seems to be doing quite well, different kind of a momentum as you compare it to IT services. So that's one segment which will continue to deliver better growth, and to that extent, within IT services, will continue to get better valuations in our.
I know liquidity and the ability to be able to have a minimum float is a very important criteria for public market investors like you. But I'm just trying to understand. A lot of these companies have been kind of bucketed as unsafe as a category. We were looking at data in 2017, probably had better gains from the low free float companies than the current ones as well. So it's not that they are really screaming off the pack, even though they have gained quite a bit. And some of these businesses look very solid. It's just that there is a low free float right now. My question to you is, one, have you invested out there, not there? But that might be criteria. But two, if there was no such criteria, are there some businesses which look promising even within the low float category, if you will?
Yeah, I don't think just the float can be a criteria for investing or not investing. Clearly, we need to evaluate business management first and then the valuations. And then finally, we need to look at liquidity, which is again a relative factor depending on the size of the portfolio and the mandate. So to that extent, it may not fit into all the funds that we manage, for example, a low liquidity stock. But if it fits into some of the smaller portfolios or some of the mandates, which anyways are looking at such kind of a market capitalization bucket, etc., or a theme, then we go ahead and do that. But in case of lower liquidity stocks, obviously the due diligence that we need to do is a lot more, because in case we go wrong, then there is no way coming back from those positions. So to that extent, in terms of portfolio sizing, in terms of timing, etc., we have to be a lot more careful as compared to some of the liquid or large float names that are available. So that is definitely a differentiating factor whenever we look at stocks from a liquidity perspective.
Got it. Harsh Upadhyaya, take a moment to thank you for joining in today and giving us your thoughts, and much appreciate your time. And to you and Team Kotak and your family, Harsha, from all of us at BQ Prime, wishing you a very happy Diwali and a great festive season.
Thank you, Neeraj. Thank you so much, and wish you, BQ Prime team, as well as all the audience who watch BQ Prime, a very happy and a prosperous Diwali this time around. And I wish that their investments also become successful in the next coming year.
That's a great wish. Thanks, Harsha, for joining in today. And viewers, thanks for tuning in.